Today's video, although not an exciting topic, is nonetheless extremely important if you do or plan on ever doing any type of fixing and flipping. We're going to be covering everything you need to know about property insurance, and I'm going to share with you 4 huge mistakes that I made that ended up costing me $200,000. So if you'd like to learn from my mistakes, then don't miss this video coming up.
For a limited time, you can get a free copy of Jerry Norton's Quick Start Kit with everything you need to flip your first house in 30 days or less. Download it now at myquickstartkit.com.
Hey, if you're new here to this channel, I'm Jerry Norton with flippingmastery.com, and this channel is all about ways to help you make money wholesaling and flipping real estate so you can live your dream life. Be sure to subscribe and turn on the bell notifications so you don't miss new videos. Boy, what I would have given to have had this video and what I'm going to be sharing with you today when I got started fixing and flipping houses 15 years ago. You see, I had 4 different disasters happen over the years on 4 different fix and flip deals that my insurance policies did not cover, costing me $200,000, which is going to be a little painful for me to discuss. Now keep watching and I'll explain what happened, the lessons I learned, and how you can avoid making the same mistakes. It's important to know that not all property insurance is created equal, and not all property insurance is one size fits all. There are actually 4 different types of property insurance that may or may not apply to your fix and flip and may need to change depending on the stage of your fix and flip. Let me explain. The first insurance we'll discuss is called a builder's risk policy. Now this policy covers the property during the rehab. Once the rehab is complete, you can switch it to a standard dwelling policy, which just covers the home's structure, but not any personal belongings inside the home. Now this is normally okay because it's a fix and flip and we don't have any personal belongings in the home like a homeowner does. However, this is not entirely true in some cases. A dwelling policy considers anything not fixed to the property as personal property and therefore would not be covered. That means furniture for staging or appliances are typically considered personal property and not covered. This brings me to big mistake number 1 that I made. I did a flip a few years ago and I installed a stainless steel refrigerator, stove, microwave, and dishwasher that was to be included with the purchase of the house. On this particular flip, I spent about $5,000 on the appliance package. Well, while it was up for sale, the home was broken into and my appliances were stolen, which unbeknownst to me at the time were not covered under my dwelling policy. What I later found out was that I could have easily added what's called a rider to my policy, just insuring the appliances. That would have only cost me a few dollars more. Expensive lesson to learn, but you ain't seen nothing yet, so keep watching. The other thing to be aware of with a dwelling policy is they typically have a vacancy exclusion after like 30 to 60 days. Meaning if the house sits vacant while you're trying to sell it for longer than 30 to 60 days or whatever the policy says, then in the event of a claim, they won't cover it, which brings us to our 3rd type of property insurance, which is a vacant home policy. Now, vacant homes pose a higher risk because no one is present to catch big problems such as flooding. And vacant homes are also more susceptible to theft and vandalism. So a vacant home policy will protect you while you're waiting for the home to sell. And this brings me to big mistake number 2 I made. I had a home in Detroit that I had renovated and it was back on the market and up for sale. This was during the winter, and one night my furnace stopped, the pipes froze and busted, and since this was a slab foundation, the plumbing was in the ceiling, so it flooded my entire house from ceiling to floor. And when I submitted an insurance claim, it was denied because I did not have a vacant home policy and I was past the 30-day vacancy exclusion on my dwelling policy. That mistake cost me $30,000. I basically had to redo the entire renovation, and I'm having a little bit of anxiety just thinking about it. Okay. The 4th type of insurance is liability coverage to protect you in the event an injury occurs at your property, which is my big mistake number 3 that I learned the hard way. I had a contractor who, while working at my rehab project, he cut a 2x4 with his circular saw by laying the 2x4 across his leg when he cut it. Now, not only did he cut the 2x4, but he put a 1/2 inch deep cut across his leg. Idiot. Now, he didn't have workers' comp insurance, which I now require all contractors to have, and I didn't have liability insurance, so I ended up paying his $10,000 medical bills. And the 5th type of insurance, which is not property insurance but still worth noting, is a general liability umbrella policy, which covers above and beyond whatever the property insurance covers. What I like about a general liability umbrella is it provides umbrella protection for my entire business in the event of a major lawsuit, claim, or catastrophic loss. If you have a high net worth and assets, you can be a target for litigation, so a general liability umbrella policy can provide additional protection and peace of mind for your assets. And surprisingly, it's not very expensive. Quick pro tip, it is possible to get a specialized policy designed for flippers that is just one policy that covers all of the different phases of the rehab. Now, if that's something interesting to you, I'll put a link to an insurance agent in the description box below who can help you, and you can check that out later. Now let's talk about the amount of coverage, but first, let me give you another pro tip. Be sure when discussing your policy with your insurance agent that you ask about a pro-rated policy so that when the property sells, you get reimbursed any amount you paid for past the date of the sale. So for example, if you buy a 6-month policy but you flip your house in 4 months and then cancel the policy, make sure you get reimbursed for the 2 months. Now, not all carriers do that. Okay, now let's discuss how much insurance you should get. For years, I would only insure my fix and flip homes for my total capital investment in the deal. So if I bought a house for $75,000 and I plan to put $25,000 into the rehab, I would insure it for $100,000. Now that is until this deal, which was my biggest mistake so far. This was a house I had bought for $200,000. I put $200,000 into the rehab, so my total capital investment on the deal was $400,000, which means I got property insurance for $400,000. Now, after about a month or so on the market, I had secured a buyer for $650,000, so this was going to be a home run deal, and then this happened. There was a gas leak, it compressed, the water heater ignited and exploded, and the house caught fire and it burnt to the ground. Now, side note here, it took 5 different fire departments to put this fire out, and I just sat there and watched in horror. In fact, I'm sweating just thinking about it. Now, luckily, thank God, no one was hurt, and this time you'll be happy to know that I had all of the right insurance in place and my claim was paid in full. So, happy ending, right? No, because I had only insured it for $400,000, which was my cost. Now, that did allow me to pay off my investors, which was good, but I had a buyer for $650,000, which means I didn't insure my profit, and I ended up not making any money on the deal, which was extremely disheartening after putting in so much work into the project. So the lesson cost me about $150,000. Now, I insure all of my fix and flip projects for my after repair value, not my cost. By the way, another pro tip here for you, if you have investors or partners, be sure to add them on all of your policies as what's called additionally insured. Now, it usually doesn't cost any more, but it adds them to the policy and gives them protection as well. Now, I just shared with you like $200,000 in mistakes that I've made that could have been easily prevented had I known better, which actually brings me to a good point. There is a cost to doing this business. You can pay by making unnecessary mistakes and learning the hard way, like I did, or you can pay to invest in tools, training, and mentoring and learn how to do it the right way. Either way, there is a cost. The hard way takes a lot longer and it is 10 times more expensive than doing it the right way. So if that makes sense to you and you'd like to 10x your results, then be sure to check out my mentor and partner program called Fast Track. It is by application and interview only. To learn more and watch a free 45-minute training about how my Fast Track program works, go to fasttrackwithjerry.com and register for an upcoming training. Hey, thanks for joining me on this video. If you learned something, show some love, hit that like button right now and leave a comment. Let me know your biggest takeaway from this video. I'd love to hear from you. And if you haven't yet, be sure to subscribe to my channel. I'm dedicated to helping you make more money in less time wholesaling and flipping houses so you can live your dream life. And I'll see you on the next video.